Renting is just throwing your money away. We have all heard this phrase. For decades, it has been treated as an undeniable financial truth. Homeownership has been sold as the ultimate marker of financial maturity, while renting is often painted as a temporary, wasteful holding pattern. But if you are looking at the financial landscape today, blindly repeating that old advice can cost you hundreds of thousands of dollars. The math behind housing has radically shifted, and the old rules no longer apply. To understand the reality of housing convenience and wealth building, we have to look at the hard data. Currently, the national median price for an existing home hovers around $420,000. At the same time, average 30-year fixed mortgage rates are sitting between 6.3% and 6.6%. Meanwhile, the national median monthly rent is tracking between $1,800 and $2,000. If you just plug those baseline numbers into a basic online calculator, you might assume that buying a home is the obvious choice because you eventually own the asset. But basic calculators ignore how money actually moves through the economy. To find out whether it is truly better to rent or to mortgage, we need to look at what economists call unrecoverable costs asterisk. When people argue that renting is throwing money away, they are focusing on the fact that rent is an unrecoverable cost. You pay your landlord and that money is gone forever. You don't build equity. What most people fail to realize is that homeownership also carries massive, permanent unrecoverable costs. In fact, in the early years of a mortgage, a staggering amount of your monthly check is completely thrown away. Let us break down the true anatomy of a mortgage payment using real numbers. Suppose you buy a median-priced home for $420,000. You put down a 5% down payment, which is $21,000, and borrow the remaining $399,000 on a 30-year fixed mortgage at an interest rate of 6.3%. Your baseline principal and interest payment comes out to approximately $2,474 every single month. But you cannot live in a house by just paying principal and interest. You have to layer on the hidden costs of homeownership. First, there are property taxes. At a standard national average, you can expect to pay about $350 a month. Next is homeowners insurance, which adds roughly $200 a month. Because your down payment was less than 20%, your lender will require private mortgage insurance, or PMI, adding another $125 a month to your bill. Then comes the most underestimated cost of owning a home: maintenance. Real estate experts and financial planners utilize the 1% rule, meaning you should expect to spend at least 1% of your home's total value every year just to keep it from deteriorating. On a $420,000 home, that is $4,200 a year, or $350 a month, spent on roofs, plumbing, HVAC systems, and general upkeep. When you add all of those pieces together, your actual out-of-pocket housing cost isn't $2,474. It is $3,500 a month. Now, let's look at where that $3,500 actually goes. Because of how mortgage amortization schedules work, your early payments are heavily front-loaded with interest. In the very first year of your mortgage, out of that $2,474 of principal and interest, only about $380 goes toward paying down your actual loan balance. The remaining $2,094 goes straight to the bank as interest. When you combine that interest with your property taxes, your insurance, your PMI, and your maintenance budget, you are spending roughly $3,120 every month on unrecoverable costs. That is $3,120 a month that does not build equity, does not increase your net worth, and is gone forever. Compare that to renting a similar, comparable property for the median rent of $1,900 a month. If you pay $1,900 in rent and $25 for renter's insurance, your total unrecoverable cost is $1,925. Mathematically, the renter is actually throwing away less money than the homeowner by a margin of over $1,100 every single month in the initial years of the housing cycle. This brings us to the core engine of financial convenience: opportunity cost asterisk. When you buy a home, you have to tie up a significant amount of liquid cash up front. For our $420,000 home, you paid a $21,000 down payment. You also had to pay closing costs, loan origination fees, title insurance, appraisals, and government fees typically account for 2% to 5% of the loan value. Let's call it a conservative $9,000. That means the homeowner had to hand over $30,000 in cash just to get the keys to the front door. If you choose to rent instead, you keep that $30,000 in your pocket. If you take that capital and invest it into a liquid, diversified index fund tracking the S&P 500, history shows us a very different wealth-building trajectory. Over the long term, the US stock market has delivered an average nominal return of roughly 10% per year. On the flip side, long-term historical data from the Federal Housing Finance Agency shows that residential real estate in the United States appreciates at a long-term average of about 4% to 5% annually, tracking just slightly ahead of inflation. Let us run the numbers across a 10-year timeline to see how these two strategies compete. If the renter invests their initial $30,000 into the market and consistently takes the monthly savings they gain from renting, let's say they save and invest $1,000 a month out of the difference in housing costs, their portfolio compounding at 10% annually will grow to over $260,000 in 10 years. That is highly liquid wealth that can be accessed at any time. Meanwhile, what happens to the homeowner? If their $420,000 home appreciates at a steady 4% per year, it will be worth roughly $621,000 in 10 years. They have gained $201,000 in equity from price appreciation, and they have slowly paid down their mortgage principal by about $55,000. On paper, the homeowner has accumulated roughly $256,000 in home equity. When you look at the total numbers side by side, the financial outcome after a decade is incredibly close. The renter built $260,000 in liquid stocks, while the homeowner built $256,000 in a liquid real estate. This proves that renting is not a financial failure. Renting is simply a different method of allocating capital. However, the math is not uniform across the board. The financial convenience of a mortgage versus renting depends entirely on two crucial variables: your geographic location and your time horizon. Let us look at the regional data. The rent versus buy calculation changes drastically depending on your zip code. Recent housing market data reveals that buying a home is actually cheaper than renting on a monthly basis in roughly 58% of US counties. This advantage is heavily concentrated in the Midwest and parts of the South. In cities like Cleveland, Chicago, Indianapolis, or Birmingham, lower home prices relative to local rents mean a mortgage can immediately save you $200 to $500 a month compared to renting. In those markets, buying is a powerful financial move. But if you look at the West Coast or major coastal metro areas, the data completely flips. In over 83% of Western counties, renting remains significantly cheaper than buying. High property valuations create a massive monthly cost gap that makes renting the overwhelming mathematical winner, freeing up thousands of dollars a month to be deployed into higher-yielding investments. The second major variable is time, which gives us the 5 to 7 year rule ****. If you plan to live in a city or a specific house for less than 3 years, buying is almost always a financial mistake. The transaction costs of real estate are incredibly high. You pay 2% to 5% when you buy the home, and when you decide to sell, you typically pay another 5% to 6% in real estate agent commissions. If you relocate within 3 years, those transaction fees will completely wipe out any equity you built or any minor market appreciation you achieved. Between 3 and 5 years, the math is a toss-up. It depends on whether your local market experiences a sudden surge in appreciation, but once you pass the 7-year threshold, the financial scales tilt heavily in favor of a mortgage. There are 2 reasons for this. First, as time moves on, your mortgage amortization schedule shifts. Every year you hold the loan, the amount of your payment going toward interest drops, and the amount going toward your principal rises. You start building equity at a much faster rate. Second, a mortgage provides protection against inflation. When you sign a 30-year fixed mortgage, your primary housing cost is locked in stone for 3 decades. Renters do not have that luxury. Historically, rents increase by an average of 4% to 6% annually. A $1,900 apartment today could easily cost $2,800 a month a decade from now. For the homeowner, while property taxes and insurance will rise slightly with inflation, their core mortgage payment remains exactly the same. Over a long enough horizon, the fixed nature of a mortgage creates a massive financial buffer that renting simply cannot provide. So, how do you actually make the decision for your own bank account? You need a clear, unemotional framework. First, calculate the asterisk price-to-rent ratio ** for your specific neighborhood. Take the purchase price of a home you want and divide it by the annual rent of a perfectly comparable property. If the resulting number is under 15, the market is telling you that buying is a bargain. If the ratio is above 20, the market is heavily weighted toward renting, meaning you should rent and invest your cash elsewhere. Second, look at your career and life trajectory. If there is a meaningful chance you will change jobs, get married, move states, or downsize in the next 5 years, prioritize the flexibility of renting. Do not anchor yourself to a massive liability like a mortgage prematurely. Finally, evaluate your own financial psychology. The math we discussed assumes that a renter will actually take their monthly savings and invest it diligently into the stock market. But humans are not robots. For many people, the money saved by renting isn't invested. It is spent on vacations, dining out, and lifestyle inflation. A mortgage operates as a forced savings account. It forces you to build a net worth because a small piece of every monthly payment acts as equity accumulation. If you lack the strict discipline to invest your surplus cash every single month without fail, buying a home is historically the most reliable path to building long-term wealth. The debate between renting and mortgaging is not a battle between a smart choice and a foolish one. Renting is not throwing money away, and a mortgage is not a guaranteed golden ticket. Run the numbers for your specific zip code, evaluate your personal timeline, account for the hidden unrecoverable costs of ownership, and pick the strategy that fits your actual life.